Okay, welcome everyone. We'll start our LO2. Today lesson will go through LO2, which is about be able to prepare budgets for organization and analyze causes of cost and sale variance. So my name is Anjum Satar and my email address anjum@ukversity.co.uk. If you have any question, please drop me email. Those are listening. Okay, so first of all, please, always good to be reflect how much we know about financial management. Scale 1 to 10, what we think now?
6, 7.
Good. And today lesson indicative content, what we supposed to be learn: budgeting process, functions, administration of budgets, sales and production budget, sensitivity analysis, flex budget, incremental budget, activity-based budget, zero-based budget, limits to budgeting, operation of standard costing, variance, ability to suggest improvement, and how standards are set, and reconciliation of budget, contribution and reconciliation of budgeted and actual profit. All will be in our discussion. Any question?
No, it's fine. Thank you.
Okay, so first assessment criteria, we have 2.1, which is about prepare the sensitivity analysis and flexible budget. Sensitivity, as the word indicates, sensitivity analysis is the method used to incorporate uncertainty. Uncertainty means probability of happening something, the chances, yes, it can go both ways, into the decision making process. Decision making is means selecting the best course of action. We have various alternatives and we selecting the best course of action. By taking each uncertainty factors in turn, calculates the changes that would be necessary in the factors before the original decision is reversed. So typically involve the posing and what if questions. By using the technique, it is possible to be established estimates variables are more critical than the others affecting the decision. So best estimate of variables are made, the decision arrived, like a material price, like a selling price, yes. But it can go up, it can go down, how many percent, what inflation rate will be. These are all variables. Each variable lies in turn to see how original estimate can change. Think about population. If the population increasing, our budget need to be increased. If our activity increase, we are producing more, we serving more people, we have a big family now instead of small family. So our budget need to be increased. Our source of income need to be increased. So for example, it may be estimated selling price can fall by 5%, like Brexit for suppose, yes, or increase by 5% before the original decision accept the project is reversed. Like, one of the company being recently went into liquidation, Carillion construction company, yes. The reason is, of course, they have a competition. They used to charge contract lower price, and ultimately their cost was high and their efficiency issue, and ultimately they can't sustain it. So we need to be look around. Estimate each variable can be reconsidered, assess the likelihood. Likelihood is mean the chance of occurrence. Probability. Be wrong. So for example, the change of selling price falling by more than 5%. Like if you go somewhere, you think, oh, half an hour normally is a travel time. Peak time you keep maybe 10%, 20% flexibility, yes. Or if it's other time maybe you keep 5%. So you have to think about so we will be on time, yeah. So individual units, selling price, variable cost per unit, all we need to be keep what effect will be. Okay, if we look here, the manager is considering if made in-house, if made rebatch, yes, buy. So variable cost we've been given, selling price ultimately we've been given, what can be, so 10 and 15 is selling price. So 15 minus 10, what is the contribution is a 5. Yeah?
5.
So if we'll buy 6 plus 2, 8, and we can sell 14. Yeah. So we have contribution there. Is it 6? Yes. So we have so
That's
5.
buying and rebates, this one.
A rebadge, remanufacturing or something.
Okay.
So we can say 6 and 5. Yes.
Yeah.
So calculate the sensitivity analysis. So for indifferent, the contribution outsourcing need to be fall 5. Yes. This is outsourced. If need to be 5, the external purchase price only need to be increased by 1%. Yes.
1%.
So then will be equal. So we'll say 1 over 6. Yes, we're looking all the possible options. If this outsource, yes, contribution is dropped by from 6 to 5, because the selling price if increased to 15.
15.
Okay, so the cost will increase. So what we need to 1 over 6 is a 17% probability. Yes, 17% is sensitive if one will drop or increase.
Yeah.
So if the external purchase price rose by 17%, external purchase price rose by 17%, what will be happen then? Yes. So that's we done. So there is a no complicated theory. Information will be presented to manage manage the firms.
Hello. Hello. Hello.
Hello.
Hello.
So
Yeah.
so likelihood, so we can look around strength of sensitivity analysis and the weakness of sen. It's assumed the changes variable can be independently. Material price will change independently of other variables. So what we can look around in sensitivity, how sensitive is 17%, 20%, yes. So we look all possible options and we can say like labor cost is very sensitive. Why? Because every year labor cost is go national minimum wage, yes,
Yeah.
and other is a supply of workers, yes,
Supply
demand,
workers. Oh.
demand and supply, because the Brexit,
Mhm.
maybe low skills or the high skills, there
Yeah.
can be a shortage, so that can be affect our budget.
Yeah.
Okay, then we're looking fixed and flex budget. Fixed is means stay the same.
According to the level of activity, na? Production of activity.
Yes. So flex is mean change and fix means stay the same. So that's so fix always stay the same. So okay, yes, I'm thinking last lesson we discussed as well, because it was part. So fix is stay the same and flex will change. So according to the actual activity. So then preparing, when we'll prepare the flex budget, we always need to look around the cost behavior. Yes.
Yeah.
Cost behavior. It can be fixed,
Or variable.
variable, semi-variable, and step.
Step.
Step cost is also fixed. Okay, so variable cost, the cost will change with the level of output. Fixed cost will stay the same like a rent. And semi-variable is like a phone line rental where fixed and variable together. Line rental is a fixed and call charges are variable, so that's called semi-variable. And other is so that's we can look around in the cost behavior. Okay, flexing. Always, if the actual activity is more, always your fixed budget need to be flexed. Fixed budget need to be flexed according to the actual activity. So always we need to be look around what is my actual activity. Okay, so we can look around here. Suppose J Limited has prepared the budget. Forecast is 50,000 units. So this is the budget for 50,000 units. That's the fixed budget. Okay, but actual budget is 37,500 units we produce. So we can't really, because the budget was 50 and actually, so our variance is coming adverse here. And if we look, the 50,000 units is coming now favorable. Actual expense is less because actual activity is less. But that's why that's not a good comparison. So what we need to do, we need so we need to be think about, yes, fixed and flex budget. Okay, so when we flex, so our activity will be 37,000. Actually is a 37,500. So fixed budget, like in the previous slide, 1,500,000 divided by 50,000, you find per unit selling price. It times by 37,500. So you can prepare the flex budget based on the fixed budget. So then flex it. We did according to the activity. Then you compare. Now you will see our variance revenue is adverse variance. Material is adverse variance. Labor was adverse variance. And production overhead is a favorable. So overall our variance is 78,500, which is adverse variance. Our profit is went down by 78,500. Our profit went down 78,500 due to hello.
Hello.
Yes, I don't know the reason.
Is making problem.
I think so. Is the internet issue something?
Just I put from my mobile phone. That was okay. I think
Okay,
so.
maybe home internet signal drop. So that's so that's the fixed and flex budget. Fixed is
Yeah.
means stay the same. Flex is mean what is actual activity same. Yes, based on your fixed budget, you can is a standard costing, and thus we prepare the budget. Our overall our variance is adverse as a profit 78,500. So we can it should be according to budgeted figure this, but actually we have 22,750. So that's we have adverse. Hello.
Hello. Yeah, I can hear.
Okay, so we can look around the causes of variance. Variance material has two types of variance: material cost variance and material usage variance.
Yeah.
So material cost variance, overall, material can be price variance and the material usage variance. Maybe the price you bought the lower price material from China, but the lower quality material need more usage. Yes. So more usage mean, so you have to look around what is, if the usage is more but the price was very low, the overall variance can become favorable. Yeah, which is fine. but you have to think about now what will be long-term impact. So what we said, performance equal to always time, cost, and quality. Yes.
And quality of the product.
If you're saving at the cost, maybe your labor is using more time because the material was low quality,
Yeah.
and they have to use. And other thing, the quality
Quality of the product will be bad.
bad, and ultimately customer satisfaction will be lower. So
Lower.
we can that can be leads to in the long run problem.
Yeah.
So we discuss about labor you can hire from the agency to save the cost price wise. Rate may be lower, but actually overall you have to think about what impact will be on the product. Yes. So these are all the causes of variance. Maybe you budget and the supply of the labor is low due to the Brexit, and you have to pay more money to hire the people, like teaching sector, like uh, doctor NHS, have a shortage of nurses. So there can be the variance. So these are the reason, and how we can try to minimize the variance or we convert into the favorable. Only we can if we have a good information, we have a good research, if we have a good planning, then we can, otherwise we can't. Okay. Next we're looking 2.2, apply the budgetary technique and use incremental budgeting, activity based budgeting,
And zero based.
zero based budgeting. So what is the activity based? Activity, if you have a more activity,
Yeah.
your cost will be more, such as uh, delivery. Yes. If you do more deliveries, your cost will be more. Yes.
Yeah.
You have to do the route planning. If you reduce the delivery, your cost will reduce. So that's why this is activity based costing. Then the second, like here, we'll say the cost of the goods inward department is 10,000. Cost of driver for the goods inward number of deliveries. During 20x3, we have 1,000 deliveries. 200 of these delivery related to product X. Yes. 2,000 units of product X were produced. How many deliveries? So 10,000 is the cost. Okay, so we have 10,000 is the cost inward. We have an overall 1,000 deliveries, so £10 is each delivery. When you have 200 deliveries for the product X, so 200 times 10, so 2,000 is the cost. So how many product X we sold and produced and sold? 2,000 times divided by 2,000. So it's a £1 each delivery cost we can embed in the price. Yes. Without even telling to customer, because we know, yes, it's
Yeah, our
cost
delivery cost would be like that.
well like that, and we can set the pricing based on the activity based costing. Okay. Okay, so that's activity based costing. Okay, next we have now using the cost and the sale variance.
Yeah.
Again, these are the variance is the difference between budgeted and actual activity. Yes.
Yeah.
So that's I don't know
Yeah.
why. Okay, so we in the previously we discussed activity based. Incremental mean increase. Yes.
Incremental means the production going up So is
Yes,
cost going up?
like we've seen in 2.1, yes, incremental.
Yeah.
Okay. What about zero base? Zero base means
Whatever is coming income and the expenses is the same. That means the
yes, you start every time from zero. All estimate from zero, like a new budget. You don't have a previous data, so you estimate zero. That's okay.
yeah. One thing I can ask you here. When we do the assignment on the zero base, do I need to make an budget there, or that means the appendix?
You
How
can
do I make it?
you can do one or two examples. Huh?
Okay, but we don't need to give the sorry, what is called appendix, any question or something like that. No.
Yes, everything explain in the assignment brief discussion. Yes, which we'll go through as well.
Okay.
I already sent you the assignment brief discussion.
Okay.
Okay, you can add it in appendix. Always good to be.
Mm-hmm.
Depends. They ask you evaluate. They ask you discuss. Huh?
Okay.
If it's a discuss, so just explain and discuss. Okay, so appropriate improvement plan address the issues. So we can look around the material price factors can be material usage factor, labor rate factor, labor efficiency factor, and these can be due to the changes in yes. Reason for variance, there can be number of reasons. Yes.
Yeah.
The price, inflations, and always we look, why this is happening. So like material price variance is due to the price increase, yes,
Mm-hmm.
due to the changes in the standard of the outsource,
Yeah.
due to the inflation and seasonal variation, material usage, defective material, excessive waste, theft, yes,
Mm-hmm.
fabricate material that can be like a petrol or others, strict, the quality control, wages rate increase, and over time, yes, that can be, and the management take action, and they can make strategies how they can, maybe people not properly clock in, clock out, that
Mm-hmm.
can be leads to.
Yeah.
We should do the independent inquiries. We do audit. When we do audit, yes, that will help. Then next we have 2.3, using the cost and the sale variance, propose appropriate improvement plan. Yes, how we can. Reason of the variance might be classed as the planning control factors. Yes, variance actual outcome is measured error. That standard can be outdated. Inefficiencies and efficient operation. Random chance of fluctuations. Yes, when deciding whether to investigate particular variance, consider interdependent. Material and labor is interdependent. If you have a poor labor, yes, with no skills, they can waste the material more. Yes, you have a good quality material, but the labor is a low skills. It's no point. So you should have a high labor skilled labor, and good quality material.
Yeah.
Of course, the cost can be go up, but the quality will go improve. Materiality is means significant. Variance trend, you can look around why this is happening trend is, and controllability. Yes, how you can take the corrective action. Always investigate. Managers responsibility center should responsibility like material purchase, warehouse. Yes, these are responsibility centers, and they should be responsible. And this is called responsibility accounting. Yes, and we can give them. Okay. Then we have 2.m is we can assess how the limiting factor. Limiting factor is a three factors: machine hours, yes,
Yeah.
labor hours, and unit of production. Yes.
Yeah. Production capacity.
So we have, it's called scarcity. Yes. So we don't have unlimited resources. We have a limited resources. We have to be stay within it. But where we need to, we can, whatever the labor hours we have, we can make product A and product B. one product contribution is £10, other product contribution is £15. Where we use the more our resources, the higher contribution, yes?
Yeah.
You can, the Marks and Spencer sell maybe one item and they can earn more profit, but maybe Primark selling good few items to make same, yes?
Yeah.
We have a same labor hour, so we have to give the high contribution. Huh? So this is all about, and we can do some numericals on it. Huh? Okay, then which I'll show you some numerical. We have chapter 5, yes?
Yeah.
Which is, I'll show you, and I gave you the booklet. I'll send you further view.
Okay.
And I send you already in mailbox.
Maybe I got one email.
No problem. I'll show you here. So this is the book, yes?
Yeah.
So you have, if you look within that, yes, we have all, yes, material, overheads, yes, budgeting. So first suppose if you want zero base, type 0, yes,
Yeah.
yes, it's come about anything. And if you want budget, yes, budget, yes, standard costing,
Standard
budgeting, yes.
costing.
And you have a lot of examples, so you can causes of variance, yes, you will see here. So you can pick examples.
Yeah.
If you type limiting
Factors.
yes, you will see here limiting factors, yeah.
No, this is the budget preparation come.
Yes, yeah, limiting factors. Hello, can you hear me? Okay, hello, can you hear me? Hello, hello,
Hello.
hello. Yes, welcome.
Yeah, it's a problem. I put a mobile now on.
Okay, so like here we've been given the capacity to control the limiting factor here. We have a budget section every, yes,
Yeah.
2009 12. We have a capacity 10,000, but actually we're producing 7, 9, and 12. Yes. We have capacity here 1,000 units, but here we don't have any spare capacity. Yes.
Yeah.
We have to produce more than additional production or reduce production. Yes. So here is 1,000. Yes. Here 1,000. I make 2,000 there. Huh?
Yeah.
To it because we have a demand 12,000. So we can revise our production. We can produce 8,000 in month. Then we can produce 10,000 in month 2. And in month 3, of course, we can produce 10 as well. Yes. But overall, in the month 3, we have demand 12,000. So we can meet the demand. Yes.
Yeah.
So limiting factor was capacity. Yes. We can
Yeah.
do the planning and we can do it. Other is here buying in our not. Yes. Production. So we look around possible buying in cost. Yes. And we can find the contribution. Yes. And then we can decide, we buy in or we
Buy and filter or buy or make.
yes, we can outsource them or we can make ourselves within a factory.
Okay.
Yes. So maximizing our contribution, we need to look around. If we have a limiting factor, yes, we have maximum labor hours available 40,000. We have a demand 10,000 and 8,000. Yes. And we have, if you look the selling price minus, so what we need to, if we'll make T product is required 3 hours per unit, so it's required 30,000 hours. And in the product J is required 16,000. Overall, we required 46,000 hours to make both products meet the demand. But we have only 40, so 6,000 we are short.
Yeah.
So what we'll do now, product T we have a contribution 6, product J we have a contribution 7. So we'll use first R. Our first rank is the, so what we'll do now, what was the contribution 7? It's required 2 hours. So 7 divided by 2 is 3. Every hour contribution is £3 and 50. And here required 3 labor hours, £6. We get the contribution as a total 6 divided by 3, we'll get £2. So our rank 1 is J. So first we'll go through for J and second we'll go through for T. So when we'll produce J required 8,000 is a demand, 2 hours is required 16,000 hours. Yes. And contribution is 7. Overall, yes. So
profit coming 56,000.
Sorry?
I think 56,000 is contribution coming from J.
Yes, 56,000 overall. Because if you make 8,000 units and sell 8,000, yes.
Yeah.
Per unit contribution is 7, yes, the product. Selling price minus variable cost. So is a 56,000. We can get the remaining hours we have now 24,000 hours. We can't make it all the product J because it's required 3 hours and demand was 10,000. We are short by 6,000 hours. So 24 divided by 3, we can make it 8,000 production for the T as well. Yes. And that will give us 6. So we can generate 48,000. So 56 plus 48, we can generate overall 104. Yes.
Yeah.
But if we'll use other way around, if we'll make the T product first, that required 3 hours per. So that required 30,000 hours. Yes.
Yeah.
So 30,000 hours. So if you do 10 times, 10,000 times 6, that give you 60,000. Yes.
Yes.
And now will remaining hours, which is 10,000, you can use towards. So if you do 10,000 divided by 2, so only we can produce 5,000 units. So 5,000 times 7, 35, yes?
Yeah.
So 60 plus 35, so total we can generate 95,000.
Yeah.
So that's why we use our resources for the higher contribution. We are earning £9,000 extra just by planning.
Mm-hmm.
You getting me?
Yeah, I get it.
Okay. So that's the way we can do the limiting factor. Okay, then we have 2.1D analyze the main elements of the costing standard. Standard cost and standard cost card, yes?
Yeah.
So we have a material A, B. We make the standard how much required, what per kg can be rate, what will be standard, what will be total material cost per 1 unit, what will be the total labor cost per unit, yes?
Mm-hmm.
And we can say what will be overall standard cost to make 1 unit, including
Yeah.
fixed variable everything. 100. So this we can multiply and then top up we can say markup and margin how much we want. Yes,
Mm-hmm.
30%, 40%, whatever. Monetary rate and resources. So standard always we need to be it can be ideal standard ideal situation. Yes, current standard based on current situation, or we can look around the past standard based on the historical figures.
Mm-hmm.
But the history can change because the whatever was before, maybe the COVID changed the way we do the business. Use the standard costing. It can be ideal standard, perfect operating condition, unfavorable motivational impact. There is a no fluctuations. 100% use. Attainable.
Mm-hmm.
Attainable is mean achievable, which allows some inefficiencies. 10% people can waste the time.
Yeah.
10% can be set up time. 10% material can be waste. Yes.
Yeah.
So it is attainable, achievable. Yes. Current,
Yeah.
based on the current working condition, no motivational impact. Yes. When basic standard is whatever you set a while ago, long time. Yes. But you
Mm-hmm.
not change it. This can be unfavorable, impact our performance. Human
Mm-hmm.
being want some fluctuation. Preparing budget, yes, we can prepare the sale budget, we can prepare the production budget, we can make the material usage. Always sales come first. If the sales go up, your budget will go up.
Yeah.
So always we look the sale budget, then you make the production budget, you can make the material usage budget, material labor usage, overhead, yes, then you can make capital expenditure budget, which is mean master budget.
Yeah.
Okay, the always keep in mind when you make budget, you look around the rejection, wastage, inefficiencies. Yes. So if 20% material fail, you have to make it. Like here, 2% supposed to be gross production rejected. Yes.
Mm-hmm.
So if 2% rejected is actually you getting 98%. Yes.
Yes.
You need to make it 100. You have to produce more. Yes. So like
Yeah.
here, total production required 2940, 2% rejection. So 2940 times 100 divided by 98. So you need 3,000 unit to make it.
Yeah.
Actually, you're selling it 2940 because the rest will be waste. So that's the way we can calculate. Yes. Wastage
Yeah.
always keep in mind when you make the budget. Yes. And then we can incorporate waste into our budgets. We can prepare our production overhead budget, which is how many, and we can prepare the operating statement. Capital budget, which is about we know the capital and revenue expenses, yes, long term
Mm-hmm.
budget, and integrity of the budget is being on ST, yes, based on
Mm-hmm.
real figures. Okay, that's and I copied the link for you here as well.
Yeah.
Any question?
No, that's fine.
So that's today was about how to prepare budget, causes of cost and the variance. That's the key.
Mm-hmm.
Okay, so I'll speak you next lesson and Guys, those are listening, any questions, drop me email. Every books and every resource already on Moodle as well, and I already send you by email.
You already sent me email, yeah?
Yes,
I'll check it. Okay, thank you so much for your kind help. Okay, and it was
welcome.
nice. Thank you.
Have a nice
Thank
time.
you. And you
Bye-bye.
take care.